Let's get even more analysis. Barbara Reinhard, we're pleased to say, is in the studio, head of asset allocation at Voya Investment Management. Well, when you're allocating in this market, it must be a very hard thing to do.
I have a hard job this year.
And talk to us about is it the volatility that's hard? Is it the fact that you're trying to preempt data versus the Fed all the time?
I think that the markets are very emotional right now, and that's what makes it very difficult. So today's jobs number was right on consensus. And, consensus it didn't mean that the labor market was getting dramatically stronger, but it didn't mean that the labor market was also starting to weaken, I think, which is what the market was primed for, which is why it seems to be such a crumbling today. So it makes it difficult because the volatility is very high, there's very thin liquidity in the markets as well, and you're starting to see things break. You had 2 central banks intervene in the past 2 weeks to stave off big problems in their currency and in their bond markets. Clearly, the Fed has global ramifications at this point.
Global ramifications for everyone else, that seems to be the narrative. Is there any sense that that's going to come back and bite us here in the U.S.?
It would be hard for it not to, right? It's always difficult to see kind of where the cracks are, but you've got very thin liquidity conditions in the Treasury market. Bond deals are getting pulled often. The high yield issuance this year is down over 75%. So, to say that there's no cracks in the U.S., I think is not an accurate statement.
When you're thinking then about these markets, some would argue from an equity perspective, valuations are really starting to look attractive. All the froth has been come off in some ways. Other people also look to a bond market and say 4% pretty much across the yield curve. We haven't seen that in a while. What looks attractive to you?
So for the equity market, we're keeping it very close to home. Our portfolios are very much tilted towards a U.S. home country bias. The developed international markets are spell real trouble for us. They're heading into recession first. Every time that you have a strong dollar and a Fed that's in a hiking cycle, it tends to spell big trouble for the emerging markets. That has unfolded. While some of those markets are very cheap, the visibility on them is not as clear as we have in the U.S. So in terms of where we're allocating assets, we're still keeping our equity position, which is very close to neutral at this point, back into the U.S. We have been adding to our long-dated U.S. Treasury position because we do believe that sometime in the next 2 quarters or 3 quarters, the Fed is going to indeed break something. And we think the yields are very attractive at this point. You're getting positive real yields for the first time in almost 10 years.
Break something. I've heard this a few times. We've been hearing it a few times, and I'm interested as to what breaks. Is it the loan market, leverage loans, LBOs? Where are you starting to see the cracks?
It's so difficult to see that, but places that we're seeing the cracks are in Treasury liquidity. We see it in, the speculative grade parts of the bond market. They're pulling deals, which is never a good sign. Also, think about where most of the assets have been allocated over the past decade. It's gone to a lot of parts of the private sector and private credit, private equity, all these types of instruments that don't have marks on them on a daily basis. Those could potentially come into some type of difficulty, but that's where we're looking for things.
But when you talk to people in that space, and granted they have to sort of put on a little bit more of a happier face, they talk about the fact is that they don't have to mark that to market. The idea is that if they are in for a downturn, they can ride that out with the expectation that, I guess, at some point they'll make it back.
They have to mark them quarterly. They do. They have to mark them from time to time for their investors.
Okay.
With that volatility, you mentioned maybe the lack of visibility. How are you thinking about the quarterly earnings season? We're getting some hints of that starting next week. And a lot of people have said it's going to be a wild ride. If you can't make your year-end numbers, we're going to start to learn that now. How are you managing that volatility?
Many companies that have pre-announced have been punished significantly. And also, we're starting to see companies that have very steady business models also give pre-announcements as well. That said, we have had our single biggest intra-quarter pre-announcement markdowns, right? So you've had big markdowns on earnings. So you're likely to be able to probably beat very low expectations at this point. It just also means that you have more visibility in the U.S. than anywhere else in the globe.